This is an Euro and USD 4 hours chart. In this video, I will compare the shooting star and the bearish engulfing pattern. They are both reversal patterns bears look out for in the market. Is one more powerful than the other? Once you see these two on your chart, something is likely to happen, and at the right zones, you are definitely cashing out big from the market. Here, you can see a shooting star, and here is your engulfing pattern. At this zone, the right price action will definitely see the market reverse for a downtrend. Let's get back to the 4 hours time frame. Remember, this is the shooting star, and here, an engulfing pattern. At the end of this video, I will explain in details the effect of the two patterns in price movements. Then you can tell me your favorite between the two, right in the comments section. Which is more powerful between the two? First, let's make use of highlighting objects. This is our A. This is a very nice engulfing pattern. We will name this B. Now, take a closer look at this market chart while we compare the price actions that happened here. A shooting star is a powerful reversal pattern, but how effective it becomes is dependent on where it happens in the market chart. A shooting star at the resistance level, with no close price actions to the left, is usually more bearish. But right here, there is market price, and here too. Drawing a box to the left of this shooting star here will paint an accurate picture. Anytime you see a shooting star giving the first signal for reversal, it's always a powerful reversal pattern compared to when it's a subsequent price action at resistance level, just as this market chart. The wider the space before the next market price, the better. Had it been, there is no market price at this level in the market chart, we might be looking at a downtrend right after the shooting star. However, the sideways movement of market prices means price consolidation. This forms chart patterns which are huge trend reversal indicators. The shooting star would have been more powerful had it been formed here. Shooting stars are good for trend breakouts when it appears here. Many traders watch out for this candlestick, but there is a lot to look out for other than price rejection. A doji formed after the shooting star. But this didn't give a confirmation that the bears has taken control of the market. Rather, it signals indecision in the market. So, it affected the strength of the shooting star. Having a big bearish candlestick here instead would have been more effective. In a nutshell, the price action surrounding a candlestick pattern should be paid attention to as well. This contributed to why the market couldn't begin a downtrend from here. At B, we have a bearish engulfing pattern. The engulfing pattern is a powerful trend reversal pattern when it appears at the right levels. Right here is a powerful engulfing pattern. After the appearance of the shooting star, which made prices come down, then an engulfing pattern formed at the same resistance level. Here is the first touch at the level, the second, the third at point A, while the engulfing pattern is the fourth. If you notice, the high and low of the bearish candlestick fully engulfed that of the previous candle. Here there is a bearish candlestick, as a confirmation that the sellers are ready to take advantage and go short. The long shadow of the candlestick is an added advantage, as this shows price rejection. A short lower shadow and a long lower shadow is a good indicator for sellers to enter the market, especially after a candlestick confirmation. You can place your trade at the close of this candlestick. Let's name it C. This is our first sell signal. When you sell the market here, your stop loss should be above the high of the engulfing pattern. Actually, aggressive traders are most likely to go short from here, while conservative traders will enter the market at point C. But their stop loss will be at the same level, above the engulfing pattern. If you notice, the engulfing pattern initiated a strong market downtrend. This resulted to a very huge profit for traders who followed the analysis. If you missed out on the entry point C, the market will always present other entry opportunities when you pay attention to details. Now, let's look at the other entry points in the market. Here is another engulfing pattern, and it's another good entry opportunity for you to be part of the huge pips movement in the market. Sell at the close of this engulfing pattern, or this point. This is our D. There was a long bearish candlestick as confirmation, and this further supported the seller's dominance in the market. When you go short, your stop loss should be above the high of the engulfing pattern here. For your take profit, you have to watch the previous price movements in the market. Before you place your take profit in the market, always be mindful of price rejections. There is also price rejection at this level. When you carefully analyze market charts this way, you will make a lot of profits. This downtrend lasted for a few weeks. Also, 1 hour candlestick shows a lot of selling opportunities. Remember, to be part of our daily signals, follow the link in the comments section. Also, be part of our broker, one of the world-leading financial market brokers, for so many opportunities.